Thank you for introducing me. Hello, I'm Daehee Jeong from Korea Development Institute. Actually, this is the first time I'm presenting this paper, so you might find some typos or errors, but I'll be pleased to answer your questions at the end of the presentation. Okay, so today I would like to talk about one of the most significant and enduring puzzles in the international economics, the interest rate parity. Actually, Dr. Packer and Dr. Shim also talk about the covered interest rate parity deviations. And my question is, I would like to take a look at the CIP deviations more closely and to see why the deviations are so large in the financial crisis. That's my motivation for this research. So before I go further about the issue, I would like to take you into the organizations of my presentation. So first, I'm going to introduce the motivation of my research. So I ask questions about why the CIP deviations were so large and less long during the financial crisis. And then secondly, I would like to introduce recently developed asset pricing theory by Garliner and Pedersen 2009, which is the asset pricing margin-based asset pricing model. And then I would like to introduce some econometric methodology and empirical procedures to answer those questions. And then I would show some research and then conclude. Okay, as you see before, Dr. Shim already showed this graph. So this is the covered interest parity deviations in Korea won and US dollars. So as you can see, the covered interest parity was quite stable from the mid-2000 to say mid-2007. It's actually quite large compared to other developed countries. I read some papers that they basically said that the CIP deviations around 2 BP or something like that, but for the Korea and US dollars, it's around, I think, in average, like 30 BPs during this period. However, after mid-2007, the dawn of the, say, subprime mortgage crisis, it started to spike up, and it's more than like 100 BPs, and after the Lehman bankruptcy around September 2008, it rocketed like 1,000 BPs. And then after some policy responses from the Federal Reserve and Bank of Korea, actually it decreased. Recent times, like May 15 or something, it stayed around like 100 BPs. So that's the history of the deviation from covered interest parity in Korea. And my question is, so what happens in these deviations during this financial crisis period? And why the deviations last so long compared to, say, like 1990s crisis? So those are my questions, and I also would like to raise some questions about recent researchers about this stylized facts. Okay. So in order to ask those questions, I looked at some literature about this deviation from covered interest parity. And actually, there's a huge amount of literature about this. And for example, the Oliver by political risk, they try to answer those questions by like political risk and transaction cost, or capital culture of government, or institutional weakness, and something like that. And recently, Baba et al., I think probably Dr. Packer, also involved in the project, and by counterparty risk and credit risk. And recently, I find this paper by Garliner and Pedersen show that the low won price, which means If two assets have the same cash flow, they should have the same returns. Expected returns should be identical, or the price should be same. However, this law can be violated when the investor funding constraint is binding. That means if the funding liquidity is tight, then there should be some irregularities. So even in the equilibrium, those two identical cash flow assets should be priced differently. So that's the theory by Galliano and Patterson. So I was very interested in that paper, and I just tried to apply some empirical work and see whether those theories work in applying this deviation from corporate interest rate parity. And recently, Coffey et al. Showed that actually they use the theory of Galliano and Patterson 2009, and they use some empirical proxies for the margin conditions. Because it is a margin-based asset pricing model, so they try to use some data based on the Euro and USD data and show that the cost of capital and the margin conditions are significant determinants of the CIB deviations. And so there is a paper about this margin-based asset pricing theory, but when I read the paper, my question was, okay, so I think the margins on the currency pairs are not observable, and they use some proxies for that. So I just wondering whether, is there any way to examine whether those proxies are appropriate? So that's my first question about on this project. And related, Bruno Meyer and Patterson 2008 show that the margin spiral are emerging if the margins are increasing in the market illiquidity. Here, the margin spiral is basically something like feedback effects. So, because of the margin requirements, when the economic fundamental is bad, then so the prices will be fallen, and in that case, the investors are forced to sell the assets, and then because they all sell the assets, the liquidity will be decreased, and then this liquidity will increase the margin requirements, and then that feedbacks to the forced to short or something like that. So this is kind of spiral things, and one of the assumptions on the spiral is that whether the margins are increasing in the market illiquidity. So I was just trying to see whether the margins are indeed increasing in the market illiquidity. So I got two questions in my project, and from this later slide, I would like to answer those questions. So let me briefly introduce the margin-based asset pricing theory and about my econometric methodologies and empirical procedures. There's some notations, but I'm trying to explain simply. So a margin-based asset pricing model has been proposed by Galliano and Patterson, 2009. And actually, this model is two agent and two riskless assets and a margin constraint model in continuous time. And basically, there are two agents. One agent is risk averse and the other agent is risk neutral. And there are two riskless assets. One is collateralized loan, and the other is uncollateralized loan. And there are kind of limited participants in those two markets. So risk neutral agents can participate in the uncollateralized loan market. However, the risk averse agents cannot participate in those markets. The margin constraint here is the main driver of the failure of the law of the one price. and that's the key component here. So I'll explain about the margin constraint in more detail. So that equation basically says that the maximum capital usage for the trading risk assets in the uncollateralized loan should be less or equal to his or her total wealth. So in here we got the absolute values for the portfolio choice theta IT. That basically means that whenever you short or long, you need to post some capital. That's about the margin requirements. And about the proportion in the uncollateralized loan, eta T, you got no absolute values there. So if you long the asset, then you will have the you will have the decreased capital. However, if you short the uncollateralized loan, then you got more capital. That's the one of the important point in this margin constraint. Okay. So this is the result of this margin-based asset pricing model. So basically, those are just first order conditions. So first order condition with respect to eta T, that basically gives you the second equation. So the rate on the uncollateralized loan, the spread between uncollateralized loan and collateralized loan should be equal to this psi T, which is the shadow cost of capital of the risk neutral agent. I think this Lagrange multiplier can be interpreted as some other concept, but that basically, as I understand, that basically says that that's the price of the a unit of capital use. So when the margin constraints are binding, then the investors want psi T amount of utility in comparison to 1 unit of capital. But if the margin constraint is not binding, this story doesn't work. So this whole story is about when the margin constraints are binding, which means that the funding liquidity is quite tight. So the resulting asset pricing here is given by the last equation. So required rate of return. Excess return should be determined by this. First term is the usual consumption risk premium, and the second term is the margin premium, which I call. So here, psi T times MTI basically means that because of the margin requirement, the investor require additional premium by this amount. Here, Y is just an indicator whether the investor is in long or short those positions. So based on this theory, we can say that the law of one price will be violated when the margin constraints are binding. So the equation in the middle basically says that even if they are same cash flows, the expected rate of return will be determined by this margin differences. Okay, that's one main result. However, I assume that probably the consumption risk premium might be different, so there could be some additional component there. So in the deviation of this, two assets, you might have this margin difference component and this consumption risk difference component. So because I'm running out of time, so this is about this discretization of this constant sign model. And I consider a nonlinear seed space model to extract the unobserved margin conditions. And I deal with this nonlinearity and heteroscedasticity based on already developed model by Harvey et al. 1992. So this is about the empirical procedures. So I measure the CIB deviations based on this usually defined measures. Okay. So I modified the model a little bit, but if you're interested, just please read my paper a little bit. Okay. So this is result. This is basically the graph for CIP deviations and the shadow cost of capital. As you can see, that until the mid 2008, they follow. I mean, the shadow cost capital tracks the CIP deviations very well. After that, the relationships are quite weak. And this is the result of the extracted margin conditions. Actually, it is not the margin on one asset, but it is the relative margin compared to US LIBOR. As you can see that it sometimes is positive and negative. And the important thing is that if you're using these margin conditions together with the shadow cost of capital, you can explain almost all the variations in the CIP deviations until December 2008, I think. The solid line is based on some solid line and dotted lines and based on some different specifications. So after 2008 December or January 2009, actually the shadow cost of capital and the margin conditions does not have any predictive power to explain these CIP deviations. So I think that might be because of the case that the margin constraints are no more binding after like January 2009, or because of Dr. Packer and Shim said that maybe the Fed swap lines announced on October 2008, and after that, the foreign currencies that came into the market, and that might affect the conditions. And so I think that answered my first question, and my second question is whether the market illiquidity increased the margins. So the dotted line is actually the relative margins, and the solid line is some proxy for market illiquidity. As you can see, it's not very close, but the important part here is that after January 2009, they are very stable. And before that, the market illiquidity quite well tracks the margin conditions. So I do a simple regression to see whether they can explain the margin conditions, and it is very significant. But as you can see, the R square is quite small, so it's not very strong result. So I conclude my presentation by summary. So I asked some questions about the CIP deviations in Korea won and US dollar. The first one is why the deviations occur, and why. And the second question is whether the market illiquidity increased the margin conditions. And I find that yes and yes. About the first question, the shadow cost capital and the margin conditions can explain the CIP deviations until 2008 December. But after that, they doesn't have any predictive power in explaining the CIP deviations. And about the second question, yes, the relative margins increase in the market illiquidity. Okay. So thank you for your attention, and I'm pleased to answer to any questions you might have in the discussion session. Thank you.